Hello, everybody. This is Jake Sundown, host of Jake and Gino podcast with my co-host, the multifamily mentor, the coach, chef, the father, six, the best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Jake, I'm doing great, brother. How you doing?
Always making it happen, big man. Hey, we are right there on the cusp of 2024, and I think this is time to look ahead and say, hey, what's coming down the road? You know, we don't have a crystal ball, but I think we can look at the different reports that are out there and make some educated guesses. But I think before we do that, let's take a look at what happened in 2023, because this was a turbulent year for some in the multifamily space. I guess this is going to sound a little cocky and braggadocious, but we had a great year. You know, we followed the framework, we stuck to our principles, and it was a absolutely phenomenal year for investing and acquisitions. But I think we need to take a look at this. And one of the biggest things, I think, just, the bone collector came a knocking, Gino, and there's some folks that got a little exuberant, and ultimately bridge debt, variable rate debt, syndicators getting a little out over their skis, bit some people in the rear ends, a little nip on the hiney, if you will. And ultimately you saw a lot of distress because of that. At the end of the day, people thought they were insulating themselves. These different investment groups bought rate caps, but then the rate caps expired. And what happened when they reset? It was a little bit different a story the second time around buying these. Ultimately, they went up quite a bit. Taxes, obviously go up when you buy something for more than it sold for the previous time. Insurance, we saw, especially in Florida. Payrolls skyrocketing due to inflation. Hiring was more challenging in some markets. And the rent growth slowed. Whatever happened to the 20% year over year rent increase, that we saw in some of these pro formas? That seemed to evaporate pretty quickly, no?
Yes. And for the listener, Jake got so excited about 2023 that he literally wet himself before we started the recording.
Oh,
he was so excited. He literally
I got a freshie.
he was flailing his hands. But what I want to do, Jake, is I really want to share with anybody listening why 2023 was really a great year for us. And there's a couple of reasons why. And I don't even know if you really thought about it, but what do we do in 2022 to set up 2023? We started buying deals that were smaller. We started buying land. We weren't forcing things. Things weren't making sense. And we didn't want to deviate from buy right, finance right, and manage right. And we started buying deals that were 20 units, 40 units. And people were saying, well, you got to go big. Why aren't you going bigger? Those deals didn't make sense. We weren't not only going to overpay them, but we weren't going to stress out the rest of our portfolio. So we didn't have the get there-itis. And I think if you take anything away from what you're going to listen to today for 2024 and beyond, create a framework for yourself. I would use buy right, finance right, manage right. Stick to that framework. And don't get that shiny object syndrome where all of a sudden RV parks are doing great. Let me jump there. Mobile home parks are doing great. Let me jump there. Now, if you've been in the business for 30 years or for a long time, I guess I can give you permission. But if you're starting out or if you've only been doing it for a few years, it does take several years to really get some massive traction going on. And that's why Jake and I were able to survive in 2023 and actually thrive. We closed on over 300 units in 2023 because we bought deals ourselves. We used seller financing on a deal. We were out there, and those small deals and the land deals, the brokers saw that we were still active. We were still buying. We had credibility. So people were coming to us, wanting to do deals with us. And we said no on a lot of deals. And I hope a lot of you out there said no to a lot of deals. You just know with the framework, when a good deal comes on your table and it hits your table, it's like, okay, this is the one. So what I want you all to do is really, as you're listening to this, what's your buy right criteria? What are you looking to buy in 2024? And your finance right. Be careful with finance right, because when you're chasing these deals, people are buying stabilized deals on bridge debt. Let that sink in for a second and see how risky that is. The deal is stabilized, yet it doesn't qualify for regular debt. I've got to buy bridge, and I'm smart enough to know when interest rates are going to go up. That's the risk right there. You're taking a huge risk for, I don't want to say limited upside gain, but there's not a lot of gain when you're buying a property at these price points and then trying to time it with the market. There's a lot of risk involved in that, Jake.
You're absolutely right. And the reason 2023 was great for us, it's because we were disciplined in 2022. And when other folks were reeling in 2023 because their deals were failing, we were able to go on offense and pick up deals cheap. And that's why it worked. Now, Gino talked a lot about buy criteria. What's your buy right criteria? If you're disciplined, this gets really easy. Then here's a few ways you can fill in your buying criteria. Look at what the agencies are requiring, okay? When it comes to the structure, when it comes to underwriting, et cetera. Look what the insurance companies are requiring. We allow that to dictate a large portion of what we acquire. These companies, if you want quasi government institutions, whatever, Fannie, Freddie, they know what works, okay? If they're not going to give you money on a deal because they deem it too risky, there's probably a good reason for that. And when you go out and get bridge debt and get burned and then go, what the hell happened? You went outside the parameters, okay? And I might be talking out of my ass because we buy loan to cost renovation deals with, community and regional banks, okay? And then we refi them out to Fannie, but that's fixed rate debt. That's the big difference right there. So I think when you're setting up your buying criteria, look to the agencies, look to the insurance companies and see what they're looking for in terms of what's going to be approved from an underwriting perspective, what kind of things they look for from a physical structure perspective, okay? They're going to go through and say, hey, these rails are 30 inches tall. We need them to be 36, different things like that. Build that into your criteria. It's going to make your lives a lot easier. Now, Gino's done his homework. He was up all night like a kid cramming for a test, getting ready for this thing today, and has a ton of notes on what to look for in 2024. And you know what? He's a student. It's not necessarily just his data. He went to the agencies. We're practicing what we preach here. We look to the big data to lead us in a certain direction that's going to be predictable. So G-Dad, what you got?
Jake, if anybody out there is going to tell you what's going to happen in 2024, run. Don't walk, run.
But give it some context, because guess what?
Yes.
A couple years ago, rates were never going to go up. They can't raise rates, okay? Cash is trash. You heard this drum being beaten for so long, and then what happened? Rates went through the roof. Cash is no longer trash. And that was the prediction. So, Gino, that's a fantastic point. I just wanted to give some context to it.
Let's give it even more context. When COVID hit, the world was supposed to end as far as rent collections. Everyone was going to go to foreclosure, and we were tracking. And I'm not saying they were right or wrong. They just didn't know that the government was going to come in and print an extra $6 trillion. And then inflation was transitory. Okay, how was inflation transitory when
what year was that statement made?
It was made multiple times, and the Fed's job is to control inflation. When do you think the
first one was made? Like late 2020 or 2021? It was transitory.
I would say 2021 because
early
they knew it, and not
right?
to get.
So now we're 3 years into it. Okay,
and not to get political, but the election comes in 2022. What do? Right after the 2022 midterms, they decide to jam rates up. So everyone's saying rates aren't going to go up. Now they're going to go up. Now, the last 6 months, everyone says rates aren't coming down for a while. But in the last couple of months, the Fed signaled that rates are coming down or they're not going to raise them anymore. And the 10-year Treasury has crashed as we are recording this right now. So
no,
I can give you some type of...
They're going to cut 3 times next year is what they're saying. Yeah.
Yeah. So, but they weren't supposed to cut it all. They were thinking that people were saying rates may continue to go up. So I've got notes here, and I'm going to give you what happened in 2023 and what they're predicting in 2024, and then we're going to tell you what we're going to do for the opportunities. In 2024, peak completions are being expected in 2024. That's 1 million units are under construction. The majority are coming due in 2024. That's why rents aren't growing. That's why the average vacancy they're predicting in 2024 is 5.7%. That's the vacancy rate. And if you go in certain markets like Nashville and Phoenix, where they're really coming out with a lot of inventory, be careful, because you not only rents aren't going to go up, rents may flatline, and it's not a good or bad thing. But when you see taxes,
supply and demand,
taxes are going up 10%, payroll 8.4% up, and you know what's going on in insurance, it's going to really hurt NOI. And we've seen in 2022, since 2022, property values have decreased 13.4%. So that means there was the peak back in 2022. So we're seeing cap rates actually decompress. What's the number here that
You're always seeing
they're
it in the
talking about?
rearview mirror too. Like you're always wondering, are we at the peak yet? Are we at the peak
Yes,
yet? Are we at
we're
the peak?
past the peak. So
Yeah.
the cap rates have decompressed 60 basis points since that point, and they're going to continue to. And if the reason why I think the Fed has to lower rates is they know they want a quote unquote air things over here, soft landing. They want a soft landing because they know the election's coming up and they need to prop up the economy. So with this soft landing, what they've done is they've really slowed the economy down in 2023. That's why there was very little activity, right? It's not just a market cycle, it's an interest rate cycle. So you've had the interest rate cycle go on. They slowed the economy down. Now they've got to pump it back up. And you can see what's going on in the cryptocurrency markets, in the stock markets. People are flooding back in. And one thing that Jake keeps telling me about this stimulus money that we have from COVID, it's going to be launching in the summertime as well. So you
The
have
employee
all that
tax
money.
credit's getting relaunched in the summer. Yeah.
What was that again? What tax credits?
The employee tax credit.
Employee tax credits.
There's
So
going to be a ton of money printed this summer.
So think about that. You have rates coming down. You have money that's been on the sidelines. You have money that is coming in as part of employee tax credits. The silver lining that I see in multifamily is there's a lot of debt that's coming due. Jake had mentioned rate caps. That's where I think the opportunity is in the space where people you're going to have to take haircuts. They're going to have to say to themselves, they're going to have capital calls as they've been having, or they're going to have to put these assets in the market. And as we like to say, when we go fishing down here in Florida, you're going to have to cut bait. It's one of those two, or you're going to continue the slow. And you're going to continue to see not only multifamily, I think the office space is even much more terrible shape than us. A lot of this debt starting to come due. And as these cap rates are decompressing, values are going down. That's a double whammy. Remember, you can always buy real estate. You can't always sell it or refi it. And that's where a lot of the opportunity is right now. And these sellers that have to get out because their asset is worth less than what it was, and their interest rate environment is not friendly to them right now.
Yeah, the rent growth in some of these instances is, less than what was expected, but the expense side of things is eating into that net operating income, and that's where folks are getting burned because look, Gino mentioned it, insurance, taxes, and you see some markets like Atlanta where there's Nashville, there's all these new units coming on board. There's fierce competition amongst the property managers for the talent and the folks to lease these assets up. And when you can't get the qualified property managers there, you're going to have to pay more. So then you see this inflation amongst payrolls continuing to push up, and that's continually being reported. Payrolls continue to go up. Look, good or bad, however you want to view it, that's the fact. So I think there's a lot of pressure on prices from not only the rent side of things, but also the expense side. So it's going to be very interesting to see. And Gino, I think it was a great point. The folks that bought bridge that had to extend rate caps, are they at an LTV where they can refi? Do they have enough NOI juice? Is the juice? Give me the juice. Is the juice there to be able to get you over the line into agency debt? And I think in many instances, the answer is going to be no. So what do you do? And that's going to be the interesting thing. And here's the one thing that may save them. Will the 10-year fall enough where they can get a loan to value to get these things out to agency off bridge debt? I think it's going to be very challenging, and
Jake,
only time will tell.
And I think that's part of quote unquote, is that a conspiracy? Are they trying to do that to save these operators? Do they want multifamily to crater?
They don't want. I don't think they want the economy to completely crash, right? And that's the fear. And dude, you talk about those types of defaults and the amount of money that's out there. I mean, you're talking somewhat of a financial Armageddon if all these things go under. So,
and I want to make a point that I think is popular to our listeners, but may not be popular in the overall economy. Demographics point to positivity in our sector. The median average sales price, as reported by Freddie, is $393,000. Monthly principal and interest is $2,162. The average rents across the board are $1,824. It's 16% cheaper to rent than to buy a home. Now, landlords have been demonized, but when you look at it, that's why people are renting. From a monthly standpoint, it's cheaper to rent. But when you're renting an apartment, you're not only getting, in a lot of these apartments, a fitness center, a clubhouse, beautiful amenities. When you have a home, you have to take care of all that stuff. If you have a pool, you know how much it costs to run a pool? It's like 5 G's a year to run a pool. You want to have a nice little swing set, costs you 3 G's to buy a swing set. That air conditioner breaks, damn, I got to pay $9,000 for a 15-seer air conditioner.
What's the lifespan of air conditioner in Florida, Gino? You get about 2 years out of these things, or
Dude,
what?
maybe 5 if you're lucky. But my point is, we've been demonized as landlords to say renting is so expensive, renting has gone up. Yeah? Well, what's gone up more? Buying a home and owning a home. So look at it from that perspective. It's still really positive to go out into rent housing as opposed to buying. And in a lot of markets, when you're doing your market research, look at what the rent share of wallet is. Berkady has a really great number. Is it still affordable to rent in that market? Some markets it's not. Obviously in San Francisco and parts of New York City, it may not. But if you're looking at markets like Omaha, you're looking at markets like Knoxville, these markets, it's much easier and cheaper to rent a home than it is to buy. And that is what, for us, if you're a multifamily investor long term, that's really positive news because you can continue to raise rents more or less to what inflation is. If you look at what rents were 4 years ago and where they are right now, I mean, you're lucky if you've been able to keep up with the inflation as far as those rent. I mean, we're getting $700 for a 2-bedroom 4 or 5 years ago. Maybe it's $1,200 or $1,300. But if you add in all the expenses that have risen, this is for anyone listening that's renting and that's demonizing landlords. Our NOI has grown, but the expense side has grown almost in the same congruous, same amount as it has from the income side, Jake.
Yeah, 100%. And the other thing too is a lot of these folks are on the move. You still see a lot of demographic shifts where people are moving from the Northeast to the Southeast. You see a lot of people going from California to Tennessee, to Texas, to Arizona. So a lot of these folks that are on the move, you don't want to move to a new state and then all of a sudden have to buy something. You want to feel it out. You want to live there for a couple of years, really understand where you want to live long term. So there's these 2 to 3 year windows where people really benefit from having the optionality of a rental. It really suits them so much better from a cost perspective, but also to get acclimated. And do you want to stay for the long term? And so I think there's a huge component of that is necessary for folks to make good decisions.
Jake, I was in Jacksonville yesterday. I went to go see my mom. My cousin has an apartment in the town center up there. And as I'm walking around, I'm like, this is a no-brainer. He has a garage.
Gino wants to start renting.
Jake, just hear me out for a second here. I was like, if I didn't have 6 kids, it would be a no-brainer. 2 garages. They have a car wash on site. They've got this fitness center like to die for, bro. It's like, Bally's over there. They've got this amazing pool, spa, barbecue, grill set. They've got an area where you walk in, it's just a coffee lounge, work from the place, and you're 30 feet
and you don't have to take care
from
of
the
any
town
of it.
center. Nothing.
It's like living in a hotel.
That's what it is. I mean, I was like, I cannot believe how awesome. You're in the middle of everything. You want to go out to
restaurant.
restaurants.
Of the cost of a hotel, too. Of that would be that nice, right?
Absolutely. Yeah. And so when I'm looking at it from that perspective, the demographics is millennials are starting to get to the age where they're starting to buy, but they're still not having families. Then you have the Gen Zs that are getting into the rental space. If I'm younger, I'm renting right now. I'm not going out and buying a home.
But how much is he paying for that?
He's probably paying $2,200 a month for a 3-bedroom, bro. 3-bedroom
$2,200 a month for all those amenities. Take that same $2,200 and go buy a house in Jacksonville, and tell me what you're going to get, because your quality is going to drop to the floor. Is the point? Right?
Not even close. 5 G's a month. I would probably estimate what he has as far as luxury.
For a fitness center, a pool, like that's what I'm saying. Like,
yes,
does 5 G's a month get you there?
I don't know. I don't know if it does.
I would argue against that personally.
For that location, I don't think so. Because like I said, his location is he basically walks outside and he's at P.F. Chang's. He's at Fogo de Chao. He's got all the restaurants there. He's got all the shopping there. He's got Nordstrom Cafe. You want to get up in the morning, go make yourself a coffee? Go walk 50 feet. You're at a coffee shop. That I'm just saying all of this to make you guys understand that this is not the last market cycle. The demographics have changed so much that I think renting for the long term, I think there's been a shift in the last several years of home ownership versus renting. And I think not only for the cost of it, it's just a lifestyle change for people.
Yeah, no, that's a really good point. So the next component to this is, what does next year look like for us? Because 2022, we're very disciplined. We bought some smaller units to Gino's point. We bought things that actually made sense from a cash on cash perspective, excuse me. When many folks were having to go to bridge debt, we just said, look, we're not going to overextend ourselves. We're going to stay disciplined. And then it's, people are probably sick of me using these football analogies. It's like running the ball. You might only be getting 2 or 3 yards of carry, but eventually it opens up, and you're able to exploit the defense. And that's what we did. We pounded in 2022, 2 to 3 yard pickups here and there. Then all of a sudden, deals are coming to us in 2023. The debt is no longer that desirable. So we're able to get things at 75, 85 a door, 100 plus units that make a lot of sense. 5-year fixed rate. We're using loan to cost from community banks. And now we're poised. We've renovated these units to roll them out in 2024 to agency at what I'm hoping for, 65% loan to value and at a 4.5% interest rate if we can get this 10-year, under 3. And I think that's very reasonable. So, Gino, you want to say something?
No, I'm just going to say I want to leave people, before we sign off, I want to leave people with things that they can do in 2024, because I think there's always an opportunity, right? If everyone's saying, well, now is now the right time. Well, if you're listening to this, did you think 2019 was the right time? Oh, the market's too high. Did you think 2020 was the right time? Oh, the market's too high. 2021, oh, it's got to be the time. Too high. 2022, you're always going to make an excuse for yourself. It's only the right time when you're ready for it. And real estate has cycles. So when you're ready, by the time you're really prepared, the market is shifted.
You got to be in it, bro. You got to always be in it to make it work, because it can change on a dime. And when it changes, sometimes it can feel like these shifts take a long time, but really it changes quick. But then there's this lag of absorption and things to trickle through the economy. So you got to be there and ready to catch it. And that's where we were at the beginning of 2023. And we were able to act when we saw it.
So the first thing that you can do is email me, Gino@jakeandgino.com. I'll send you a free PDF copy of Wheelbarrow Profits. Follow the framework. Learn how to buy these assets, learn how to finance them, and learn how to manage them. And that's what we talk about in the book. The second one is partner up. I want you to start partnering up with other people to take deals down. If you can't do it yourself, Jake and I partnered up. Join a community. We have an amazing community at Jake and Gino where you can find other people. If you want to co-GP, if you want to be a lead sponsor, if you want to do JV deals with others, if you want to learn how to do seller financing, if you want to buy deals by yourself, whatever that looks like. But for me, partnering up and getting other people to take deals down is going to get you into this game quicker. The third
Gino,
one.
think about it. It's like eHarmony for people that love money.
Yeah, I like that. Little trademark action there, right?
Carry on.
The third one, right now, well, you should have been doing this, but if you haven't been, right now is the time to start sourcing investors, talking to investors. When you're not doing anything in those downtimes, there's two things you could be doing: working on your branding and working on talking to investors. Now, if you've done that over the last 18 months, you're going to see the real benefits to it. If you haven't, it's never too late. Start working and talking to investors and start working on your brand. The next one, this is important to me because when Jake and I started, and a lot of the students, when they come on, a lot of the members, they don't know how to finance right. Get out there and introduce yourself to community banks, to credit unions, to mortgage brokers. That's the real, to me, benefit to joining a community like Jake and Gino. We have all those vendors. We can serve them up to you and say, hey, here's someone at Capital One. Here's someone who's a mortgage broker. These are the credit unions you are using. This is how you talk to community bank. And the reason why I'm telling you to go to these, we've had students over the last couple of months say, I've had a deal with a community bank and they've decided to withhold the loan because they don't know what the next few months are going to be, because they've got deals on their balance sheet that don't look like they're penciling out right now. So if you know the community bank and you're in there, Jake, the community banker, might call you up and say, hey, Gino, I've got this deal, this seller, this loan is not working out.
We've got 2 or 3 deals that way.
Yes, yeah. And it's coming back right now. So I'm giving you, that's the nugget right there. Talk to these community banks in your area and make sure you start creating a relationship with them, because they may have deals on their balance sheet that they want to get rid of. And if not, you're still trying to go out to as many as you can, because you want to, when you're getting term sheets, you want them competing against each other. They want your business. They want your demand deposits. That's how they make loans. The next one, Jake had mentioned it early on, create the buy right criteria. If you don't know what a buy right criteria is, go back to our podcasts on the Jake and Gino channel or our how-tos on creating your own personal buy rate criteria. And guess what? It's going to change because the deals that Jake and I were looking at 5, 6, 7 years ago, they're not the same deals because the market cycle has changed. Our skill set has changed. Our business plan has changed and it's ever evolving. So understand what your buy rate criteria is now for the next 12 months. I would still be looking at newer assets. I would still be looking at assets always in better markets, assets that have stable jobs, that have stable population, assets where people are moving into a market. Look for those kind of assets. Then you have to really chunk it down as far as number of units, unit mixes, age, vintage. We're not going to go over it here, but understand as you start getting clear in your buy rate criteria, there's less risk. So when a deal comes across your desk, you know it. And also, you can convey that message to your investors and to the real estate brokers. So when they find a deal, they can call you up. And I think the last one for me, Jake, before I let you wrap this bad boy up, is finance right. The financing component, understand that it's okay to use bridge debt. If you can move really quick, you have a solid business plan, and you've been doing it for several years. But if it's your
We've
very
never
first,
done it. Just to be straight up, we've never done it.
well, I was really amazed at the closing costs. And then on the back end, having to refinance out and use them, it's like the mafia. Well, if you don't use us, we have right of first refusal. But if you don't use us, we're going to jack you with all these additional costs. It's a great tool in the tool belt when you have a deal that's not stabilized, that you know that you can move on. But if it's your very first deal and it's 180 units and you're trying to buy a bridge debt deal and you've never done one before, I would caution against that. But if it's a 20 unit deal and you want to use bridge and you've got 24, 36 months, that may be okay. But just understand the finance component because that is one of the big two major differences in multifamily versus residential. Really, there's no MLS in multifamily. There's really broke relationships and the financing. Because financing has terms in multifamily. It's not a 30-year AM where it's 30 years and it's going out for the next 30 years. There are terms involved, whether it's a 2-year term, a 3-year term, 5, 7, 10, whatever that is. Understand the financing component before you start taking these deals down.
We say it all the time: buy right, manage right, and finance right. And you saw two major occurrences, one in 2008 and one in 2023, where financing bit people in the ass. 15 years apart. You can argue the differences all you want, but look, financing bit people in the ass in '08, financing bit people in the ass in 2023. So gang, fixed rate debt, okay? Remain disciplined and be a sniper. That's the outlook for next year, and that should always be the outlook. And as always, we believe in buying deals for the long term, thinking decades. I'm Jake. He's the G Daddy, the financing sniper. And we'll see you next time.